A loan was approved. No application. There is no borrower. And no justification. A regular compliance check at one of the biggest banks in America found a document that shouldn't have been there. A loan approval that was signed and stamped before the paperwork was ever submitted. On paper, everything looked legal. In reality, it was a quiet violation hidden behind authority, trust, and silence. Emails vanished as inquiries increased. The dates were altered, and the system started defending itself. This isn't a story about a mistake. It's about how power rewrites rules without breaking them. Because the real question isn't how the loan was approved. It's who knew it shouldn't exist and let it happen anyway. Stay till the end. The truth was never meant to be found. Daniel Mercer began by doing what all seasoned auditors are taught to do. He had faith in the system. Trust was a structural component of Liberty Crest Financial Group. Every transaction, permission, and legal sign-off was subjected to several levels of scrutiny, intended to guard against just this kind of error. Daniel did not respond emotionally when he saw the timestamp. He responded in a professional manner. Rereading the statistics on the screen, he reclined in his chair and uttered the words that had accompanied him for the majority of his professional life. It's most likely nothing. More times than he could remember, that line had prevented him from becoming paranoid. It didn't until the night. Daniel had spent nearly 12 years inside compliance and legal audit. He had reviewed loan files from market booms, recessions, regulatory crackdowns, and post-crisis cleanups. He had seen fraud dressed up as complexity. He had seen incompetence hidden behind process. He had seen greed justified as strategy. But he had never seen time behave incorrectly. In front of him, the loan file was open. $400 million. Commercial credit facility. Approved March 3, 9:14 a.m. Application submitted March 6, 10:02 a.m. 3 days later. Daniel frowned not in panic but confusion. A typo was possible. A migration glitch was plausible. A reporting delay could explain a few hours. But not this. The system audit trail was opened by him. Nothing happened at Liberty Crest without leaving a trace. Metadata was produced by each click, permission, and review. Too many fines had been imposed on the bank to permit uncertainty. Daniel anticipated discovering a manual override, or a tainted import, or a flag at the very least. Rather, the audit trail verified the impossibility. The original approval timestamp was used. No changes. No changes. Not at all. The loan was approved before it was requested, according to the system. Daniel looked over the backup servers. Same outcome. He examined the system that was physically located in a different state, known as the mirrored disaster recovery scenario. Same outcome. He looked through the regulatory reporting archive, which is the version kept for federal examination and subpoenas. Same outcome. Every system concurred. The loan was depicted in the bank's internal reality on a timeline that was inconsistent with reality. At 12:26 a.m., Daniel sent a neutral inquiry to it. Not an alert. Not an escalation. Just a question. Can you confirm whether any timestamp normalization occurred during the loan system migration? The response came back 18 minutes later. Short. Clinical. Final. No normalization occurred. All timestamps reflect original system entries. No anomalies detected. Daniel stared at the screen longer than he needed to. No anomalies. The system had just told him that the impossible was normal. He went back to the loan document. Go back and read it more slowly. Legal clearance, finished. Risk approval is finished. Treasury approval is finished. Clearance for compliance, finished. All the boxes were checked. Daniel knew the names associated with each approval. Senior experts, cautious individuals, those who made inquiries. However, there was not a single comment in the file. No conversation. No resistance. No requirements. On deals this huge, that didn't occur. Daniel then became aware of another thing. There was no order to the approvals. They happened at the same time. Within the same 60 seconds, the loan was approved by each department. That was never the case. Not in actual banking. Processes were created to create friction and slow down decision-making. Structure was questioned by risk. Legal challenged authority. Treasury raised concerns about vulnerability. There was no friction here. The choice seemed to have already been made. Daniel stood up and walked to the window. Below him, the city moved quietly. The financial district was mostly dark, with only a few towers still lit, reminders that somewhere, systems were always running. Markets didn't sleep. But this felt different. This didn't feel like urgency. It felt like inevitability. He pulled up the borrower profile. Apex Meridian Development Corp. Large, reputable, politically connected. Apex Meridian built infrastructure ports, energy facilities, transportation projects. They received government contracts. Their executives sat on advisory boards. Their donations appeared in campaign finance records. They were the kind of client banks competed to serve. But none of that explained the timestamp. Daniel compared the file to Apex Meridian's previous loans. 80 million, 120 million, 200 million. Each showed weeks of back and forth. Emails, risk memos, legal revisions. This loan, silence. It appeared fully formed, like it had been dropped into the system complete, approved, unquestioned. Daniel ceased considering mistakes at 1:40 a.m. This wasn't a scam. Fraud left its mark. There was nothing left. This was power. The non-arguing sort. The non-explanatory sort. The type that demands obedience. The next morning, Daniel raised the issue casually during a routine review meeting. He didn't accuse anyone. He framed it as curiosity. Has anyone noticed unusual timestamp behavior on large approvals during the migration? The room changed. Not defensively, not loudly. Just quiet. A senior manager shifted in his chair. Another glanced at the door. No one answered. After the meeting, a colleague pulled Daniel aside. Not to threaten him. Not to warn him. Just a sentence. Some approvals aren't meant to be reviewed in isolation. That sentence stayed with him. That afternoon, Daniel requested access to the legal template repository. A routine request. Denied. No explanation. Later that day, he noticed his system permissions had changed. Not revoked. Not dramatically. Just narrowed. Certain directories were no longer visible. Nothing overt. Enough to be noticed by someone who paid attention. That night, Daniel reopened the loan file. One last time. Slowly. Carefully. That's when he saw it. A clause buried deep in the approval language standard formatting. Standard font, but unfamiliar wording. A reference to Systemic Risk Exception Authority. Daniel froze. That language wasn't used anymore. It belonged to emergency protocols written during past crises mechanisms, designed for moments when the system itself was at risk. Protocols that were never supposed to be active during normal operations. He searched the phrase. The result appeared instantly. Systemic Risk Authorization Panel. SRAP. A committee formed during chaos. Supposedly temporary. Supposedly dissolved. Apparently still alive. Daniel leaned back in his chair. Now he understood why the system hadn't flagged anything. From the system's perspective, nothing was wrong. The loan hadn't been approved early. It had been authorized before the application existed, before the paperwork arrived, before anyone asked permission. And for the first time that night, Daniel didn't tell himself it's probably nothing. He said something else. Quietly, To himself, this was never meant to be found. To understand the loan, Daniel Mercer knew he had to understand the borrower. Not the version presented in glossy reports or investor decks, but the version hidden beneath structure, ownership, and silence. The name on the file was Apex Meridian Development Corp. At first glance, Apex Meridian looked like the kind of company banks were built to serve. Large-scale infrastructure, energy projects, ports, transportation corridors. They built things governments needed, and they built them quietly. Apex Meridian wasn't brand new. Institutional funds were involved. The kind that didn't seek attention, avoid controversy, or explain itself to others who weren't at a certain level. There were no logos in their offices. Interviews were not conducted by their executives. Additionally, they only stated what was necessary to maintain compliance in their public filings. Daniel pulled the corporate profile. Apex Meridian operated through a web of subsidiaries. Each one legally clean, each one isolated, each one defensible. No single entity carried too much risk. No single balance sheet raised red flags. From a compliance perspective, it was elegant. From an investigative perspective, it was impenetrable. He traced the ownership structure. Parent company in Delaware. Holding entities in New York. Project vehicles in Texas, Louisiana, and California. Nothing illegal. Nothing unusual. Except the pattern. Money moved sideways, not up. Loans were recycled between affiliates. Assets were cross-collateralized. Exposure was distributed just thinly enough to avoid concentration limits. Apex Meridian didn't accumulate power. It diffused it. Daniel searched Apex Meridian's board. Former regulators. Former defense contractors. Former policy advisors. Not criminals. Architects. People who understood how systems reacted and how to stay ahead of those reactions. This wasn't a company that asked for favors. This was a company the system prepared itself for. Daniel compared Apex Meridian's past loans at Liberty Crest. They were sizable but never reckless. Every deal showed negotiation. Risk memos questioning exposure. Legal teams revising clauses. Treasury adjusting collateral. This was how banking worked. But the $400 million loan was different. There were no debates. No conditions. No evidence of human hesitation. Daniel reviewed the timing. The loan wasn't tied to a project announcement. It didn't precede a contract win. It didn't follow a public funding gap. It appeared disconnected from Apex Meridian's visible operations, which raised an unsettling question. If the loan wasn't for Apex Meridian's projects, what was it for? Daniel looked at the drawdown schedule. The funds weren't deployed immediately. They were parked, held, then quietly moved. Not into construction accounts, not into vendor payments, but into short-term instruments repurchase agreements, collateralized facilities, internal credit pools. The money didn't build anything. It stabilized something. Daniel felt the story shift. This loan wasn't about growth. It was about containment. He checked market data. 3 days before the loan approval, volatility had spiked in an unrelated sector. Nothing headline-worthy. Nothing the public would notice. But inside banking systems, the signals were there. Liquidity tightening. Counterparty stress. Funding costs creeping upward. Someone somewhere had seen something coming. Daniel searched for internal alerts. Stress indicators. Liquidity warnings. Emergency thresholds. He found none. Not because they didn't exist, but because they weren't recorded. Which meant one thing. The trigger hadn't come from monitoring. It had come from authority. Daniel requested historical files on Apex Meridian's prior emergency interactions. The request wasn't denied. It was delayed, then redirected, then closed without comment. That was new. Apex Meridian didn't operate like a borrower reacting to markets. It operated like a component of the system itself. When pressure built somewhere else, Apex Meridian absorbed it. Quietly, legally, efficiently, Daniel noticed another detail. Apex Meridian never missed repayment schedules, never renegotiated publicly, never appeared in enforcement actions. Yet it appeared repeatedly in moments where the system needed stability. Like ballast, like insurance. That's when Daniel understood the real role Apex Meridian played. It wasn't just a company. It was a buffer, a structure designed to move money without triggering attention. A place where liquidity could be parked, rerouted, and disguised as development financing. Daniel closed the file and leaned back. This wasn't corruption in the traditional sense. There were no bribes, no forged signatures, no stolen money. This was something far more sophisticated. A system protecting itself by using entities that looked private but behaved public. The loan hadn't been approved early by accident. It had been approved because Apex Meridian was trusted to do something ordinary borrowers were never allowed to do. Hold risk. Silently, Daniel saved his notes. He knew now that the problem wasn't just the timestamp. It was the borrower's purpose, and whatever Apex Meridian had been used to stabilize. It wasn't over yet. Because when institutions move money before paperwork exists, it means they're racing something. And whatever they were racing was coming closer. Daniel Mercer no longer thought he was looking at a mistake by the time he got to Chapter 4 of his own investigation. Errors result in discrepancies. There were none in this system. Daniel observed a procedure that didn't wait for requests, didn't respond to situations, and didn't seek approval in the conventional sense. It anticipated. The first clue came from the language. Not the numbers. Not the timestamps. The words. Daniel reopened the loan agreement for Apex Meridian and began reading it not as an auditor, but as a historian. Certain phrases appeared that hadn't been used in years. Clauses written during moments of financial panic. Language meant for crises, not calm markets. The structure of the agreement wasn't wrong. It was outdated. Daniel contrasted the loan agreement with Liberty Crest's current standard templates. They weren't compatible. He then contrasted it with archived templates, which are records kept deep within limited legal libraries. At that point, the pattern became apparent. There was no draft of the loan. It was chosen. Liberty Crest maintained a classified set of legal templates pre-approved contracts. During previous financial emergencies, they were designed for one purpose: to move large amounts of capital instantly when hesitation would endanger the system. These templates bypassed debate, bypassed committees, bypassed delay. They were meant to be used only when markets were breaking. But the markets weren't breaking, at least not publicly. Daniel noticed something else. The loan's internal classification wasn't commercial. It wasn't corporate. It was marked systemic continuity. That category wasn't part of normal operations. It existed outside quarterly reporting, outside public disclosures, outside ordinary audit cycles. This explained the simultaneous approvals. Departments hadn't reviewed the loan independently. They'd been activated. When a systemic continuity trigger fired, approvals became acknowledgments. No discussion, no dissent, just confirmation that the system was executing a predefined response. Daniel searched for the trigger. What condition had activated the template? Liquidity shortfall, counterparty failure, market collapse. He found nothing, not because it wasn't there, but because the trigger wasn't documented, which meant it didn't originate from monitoring systems. It originated from authority. Daniel traced the approval authority upward. Beyond risk, beyond legal, beyond compliance, It led to a shadow layer inside Liberty Crest governance mechanisms that existed only in extraordinary circumstances. That's where he found it. Systemic Risk Authorization Panel. SRAP. SRAP wasn't a department. It wasn't listed on the org chart. It was a standing emergency body created after a past crisis given temporary authority that, somehow, had never expired. Its mandate was simple: preserve financial stability by any legal means necessary. Daniel reviewed SRAP's historical actions. They were rare, sparse, but consistent. Every time markets approached instability, SRAP-approved instruments appeared. Loans that moved too fast, contracts that predated applications, approvals that ignored friction. Not often, just enough. Apex Meridian appeared repeatedly in these moments. Not always as a borrower. Sometimes as a counterparty. Sometimes as a guarantor. Sometimes as a silent holder of risk. Always present. Never visible. The realization hit Daniel slowly. This wasn't a loophole. It was a pre-written path. A hidden mechanism designed to activate when the system sensed danger. Moving money into structures capable of absorbing shock. The public saw stability. The system saw risk being transferred. Daniel understood now why no emails existed. Why no debates occurred. Why the loan had been approved before the application arrived. The decision hadn't been made by people reacting to events. It had been made years ago. Encoded into policy. That night, Daniel attempted to access SRAP's historical charter. The request failed. Not denied. Failed. As if the document had never existed. The next morning, he noticed something else. The loan file had changed. Not materially, but procedurally. Certain metadata fields no longer displayed. Search indexing returned fewer results. The system wasn't erasing evidence. It was narrowing perspective. Daniel didn't confront anyone. He didn't escalate. He documented. Carefully. Quietly. Because now he understood the risk. This wasn't about wrongdoing. It was about exposure. And exposure in systems like this was dangerous. The pre-written path existed for a reason. Because when systems wait for permission, they fail. So the system had learned to move first. Daniel closed the file and shut down his terminal. He knew now that the $400 million loan wasn't a favor. It was a response. A signal that somewhere unseen by the public, stress had crossed a threshold. And whatever that stress was, it hadn't gone away. It had only been delayed. Once Daniel Mercer understood how the system truly worked, everything around him began to feel heavier. Not louder, not more chaotic. Just heavier. Because systems like this didn't rely on secrecy alone. They relied on silence. In the days following his discovery of the Systemic Risk Authorization Panel, Daniel noticed subtle changes not in the data, but in the atmosphere. Meetings ended earlier than usual. Emails became shorter. Conversations stopped when he entered rooms. No one accused him of anything. No one warned him. Which was worse? Daniel reviewed his access logs. They were clean. Too clean. The system showed no record of his deeper searches, no trace that he had accessed restricted historical templates or governance layers. At first, that felt like relief. Then he understood what it meant. Someone had cleaned the trail for him. And that meant someone was watching. The pressure didn't come from confrontation. It came from isolation. A quiet recalibration of his professional world. His name stopped appearing on new case assignments. His calendar grew empty. His workload shrank without explanation. Daniel wasn't being punished. He was being removed. At home, the silence followed him. He replayed the same question over and over. If this system was designed to protect stability, what happens to the person who disrupts it? One evening, Daniel received an internal message marked administrative. No sender name. No subject line. Just a calendar invitation. Time 7:30 a.m. Location, Executive Conference Suite B. Suite B wasn't used for compliance meetings. It was used for alignment discussions. The next morning, Daniel arrived early. The room was glass-walled, overlooking the city, a deliberate choice. Transparency without vulnerability. When he entered, two people were already seated. One from legal governance. One from enterprise risk. Senior. Controlled. Calm. They didn't ask Daniel what he had found. They already knew. Instead, they spoke about responsibility. About the difference between legality and stability. About how financial systems weren't moral structures, they were survival mechanisms. One of them leaned forward and said, "You're asking the right questions, but at the wrong altitude." They explained that SRAP didn't exist to enrich individuals. It existed to prevent collapse, to absorb shocks that ordinary compliance frameworks were never built to handle. The system moved money quietly, so panic wouldn't move faster. Daniel listened, because listening was safer than speaking. Then came the offer. Not explicit, not written, but unmistakable. A transfer, a promotion, a research role far from operational oversight. Visibility without influence. In exchange, nothing needed to be said. Nothing needed to be reported. Nothing needed to be remembered. Daniel understood the subtext. Truth wasn't being denied. It was being contained. That afternoon, Daniel returned to his desk. A new badge awaited him. New permissions. New restrictions. He could still access data, but not the paths that connected it. The system hadn't expelled him. It had repositioned him. That night, Daniel reviewed his private notes. Every screenshot, every timestamp, every inference. None of it was illegal, but none of it was welcome. He faced a reality few compliance officers ever confront. The law could identify violations, but it could not govern intent. And intent was where this system lived. Daniel asked himself the most dangerous question of all: if the system was built this way intentionally, who decides when it goes too far? Outside Liberty Crest, markets remained calm. Stock prices steady. Headlines quiet. No crisis, no scandal. Which meant the system was working. And yet, Daniel couldn't shake the feeling that something was approaching. Because systems that prepare for disaster don't do so without reason. Late that night, Daniel made a choice. He didn't escalate. He didn't leak. He did confront. He copied. One file. One metadata snapshot. One overlooked routing log that hadn't been scrubbed. He didn't know what he would do with it. He only knew this if the system ever broke. Someone would need to remember how it was designed to survive. Daniel shut down his terminal and walked into the night. Behind him, Liberty Crest glowed calm, powerful, and unchanged. But beneath its glass walls, silence pressed inward. Holding, waiting. The system did not react the way Daniel Mercer expected. There were no alarms, no sudden emails, no urgent meetings. The markets opened on time. Transactions cleared as usual. Liberty Crest Bank continued to operate with flawless precision. Which meant one thing. The system hadn't detected a breach. Or worse, it had detected it and chosen not to respond. Daniel spent the next several days in a state of controlled normalcy. He showed up on time. He attended meetings. He nodded when required. But beneath the surface, everything had changed. Because once you remove a piece of truth from a system like this, you become a variable. And variables are dangerous. The file Daniel copied wasn't explosive on its own. It wasn't a confession. It wasn't a smoking gun. It was something far more powerful. A routing log. A technical artifact showing how certain transactions bypassed standard compliance reviews not illegally, but procedurally. A mechanism, a design choice. Daniel didn't share it. Not with regulators. Not with journalists. Not even with external counsel. Instead, he watched. Because leaks don't always come from exposure. Sometimes they come from reaction. He began noticing patterns. Internal audits scheduled and then quietly postponed. Risk reviews initiated without follow-up. Compliance dashboards that suddenly stopped updating historical comparisons. The system wasn't scrambling. It was rebalancing. Daniel realized something critical. SRAP, the Systemic Risk Authorization Panel, wasn't defensive. It was adaptive, which meant it could absorb not just financial shocks, but human ones. 1 week later, Daniel received another calendar invitation. This time, it included a sender. Internal strategy coordination. No names. No agenda. Same conference level. Different room. When Daniel arrived, only one person was present. Eleanor Whitmore, Senior Managing Director. Someone whose name rarely appeared on org charts, but whose decisions shaped them. Eleanor didn't sit behind the table. She stood near the window, watching the city, waiting. She didn't ask Daniel what he had taken. She didn't ask if he planned to leak it. Instead, she asked something unexpected. Do you know why financial scandals rarely start with journalists? Daniel didn't answer. She explained calmly. Because journalists chase stories. Regulators chase violations. Markets chase certainty. But systems like theirs were built to withstand all three. Eleanor turned and looked directly at him. What destabilizes institutions isn't exposure. It's misinterpretation. She told Daniel that if his files surfaced tomorrow, nothing would happen. Not immediately. Because without context, it would look like technical discretion. Without intent, it would look like governance flexibility. Without a narrative, it would be noise. And noise gets ignored. Daniel realized then what the system truly feared. Not leaks, but coherence. Eleanor made no threats. She made no promises. She simply offered clarity. The system existed because markets demanded predictability, not truth. Truth fluctuated. Predictability didn't. She explained how SRAP had been activated during past crises, how it quietly rerouted capital to prevent panic, how it absorbed losses that would have triggered cascading failures, and how every time someone like Daniel had asked the same question. Who approved this? Her answer was unsettling. Everyone, and no one, because systems like SRAP weren't approved. They were allowed. Daniel left the meeting with no directive, no warning, no instruction to delete the file, which made the message unmistakable. They weren't afraid of him. They were confident he'd understand. That night, Daniel did something dangerous. He tested the system, not by leaking data, but by asking questions. He reached out to a former regulator he trusted. Carefully, hypothetically, he described a framework, a governance mechanism, a discretionary routing authority embedded within compliance infrastructure. The response came hours later. Short, measured, uncomfortable. If such a system exists, it likely predates current oversight. And challenging, it would require proving harm, not design. Daniel felt the ground shift. Because harm hadn't happened yet. The system was preventative, which meant it only became illegal after failure. Daniel finally understood the trap. You couldn't expose SRAP before a collapse. And after a collapse, the system would be blamed, dismantled, and quietly replaced. Truth in this world only mattered in hindsight. Weeks passed. Daniel kept the file. Encrypted. Offline. Untouched, the system made no move against him. No retaliation. No promotion. No exit. Instead, it waited, just like it always had. Then one morning, everything changed. Not inside Liberty Crest, but outside it. A regional bank failed. Small, contained, barely newsworthy. But Daniel saw something no one else did. The transaction timing, the liquidity movements, the pattern SRAP had activated. The system Daniel thought he was watching had been watching him. Daniel realized then that his file wasn't leverage. It was context, and context only mattered when history asked questions. As headlines faded and markets stabilized, Daniel faced his final decision. Leak and be dismissed as speculative. Wait and become complicit. Or stay and understand the system fully. He chose the third option. Not out of fear, but because systems like this didn't fall from exposure. They fell from miscalculation. And when that moment came, someone would need to explain how the lie was built. Not to punish it, but to prevent the next one. Daniel closed the encrypted drive, placed it in a safe, and returned to work. Because the most dangerous secret in finance isn't hidden money. It's the belief that someone, somewhere, is in control. For years, the system worked exactly as it was designed to. Quietly, efficiently, without apology. Markets stabilized before panic could form. Liquidity moved before headlines appeared. Losses vanished into structures no one questioned. And every time the conclusion was the same, nothing happened. Daniel Mercer once believed systems failed loudly. That collapse came with sirens, investigations, and indictments. But on an otherwise ordinary Tuesday morning, inside Liberty Crest Bank, he learned the truth. Systems like this don't fail with noise. They fail with delay. The first signal was barely noticeable. A minor inconsistency in overnight funding rates. Nothing alarming. Nothing reportable. But to Daniel, it felt familiar. Too familiar. He turned to his terminal, tracing liquidity flows across the system. Repo markets, interbank transfers, settlement windows. And there it was. A pattern he had seen before, never this large. SRAP had activated. Again, this time it wasn't stabilizing a regional institution. It wasn't isolating a localized shock. It was intervening across multiple major banks simultaneously. Daniel felt his stomach tighten. SRAP was never built for this scale. It was designed for isolated stress events, not systemic overlap. He pulled historical logs, compared activation windows, mapped exposure paths. The data revealed a truth no one else was reading. Yet, the system wasn't preventing collapse. It was concentrating risk. Daniel stood up and looked around the compliance floor. Phones rang. Keyboards clicked. Coffee machines hummed. Everything looked normal. And that was the danger. Because by the time panic became visible, it would already be too late. Daniel requested a private meeting. Not with compliance. Not with risk. With Eleanor Whitmore. She agreed immediately, which meant she already knew. They met in the executive suite, glass walls, city skyline, familiar setting. But the tone had changed. No metaphors. No philosophy. Only data. Daniel explained how overlapping SRAP activations distorted liquidity signals. How institutions were unknowingly leaning on the same invisible backstop. How a single miscalculation could trigger a cascade no model could contain. Eleanor listened without interruption. Then she asked one question. How much time do you think we have? Daniel answered without hesitation. Less than anyone is willing to admit. That was when the system revealed its final weakness. Not greed. Not arrogance. Confidence. Eleanor spoke the truth no one else would say aloud. If SRAP were shut down, markets would notice. If markets noticed, confidence would break. If confidence broke, collapse would accelerate. The system was trapped. Too embedded to stop. Too trusted to expose. Too large to question. The choice was no longer moral. It was architectural. That night, global markets trembled. Not enough for headlines. Enough for algorithms. Liquidity dried up where it shouldn't have. Spreads widened without explanation. And somewhere between Tokyo and London, a chain reaction began. SRAP responded automatically. Aggressively. Blindly. The system did exactly what it was designed to do. And crossed a line it was never meant to approach. By morning, the story had shifted. One major institution announced emergency restructuring. Then another's. Then another's. Markets didn't crash. They hesitated. And hesitation was worse. Daniel watched the data unfold in real time. He knew what came next. Someone would need to be blamed. Not for the system, but for the moment it failed. Internal reviews began immediately. Emails surfaced. Logs were analyzed. Access histories reconstructed. Daniel's name appeared. Not as the architect, but as the witness. Because he had seen the system, documented it, understood it, and never stopped it. The narrative formed quickly. A compliance failure. A delayed escalation. A professional judgment error. Daniel was called in again. This room had no glass walls. They didn't accuse him. They thanked him. Then they placed a document in front of him. A standard separation agreement. Non-admission. Non-disclosure. Clean exit. Daniel read the final clause carefully. It stated that SRAP had never existed. That was the real lie. Not the money. Not the mechanism. The erasure. Daniel refused to sign. Within hours, markets stabilized. Emergency liquidity measures activated. Governments intervened quietly. Confidence returned. The system survived. Daniel did not. He resigned the next morning. No press. No scandal. No interviews. Weeks later, an official report was released. Technical language. Carefully constructed. No mention of SRAP. No mention of discretionary routing. No mention of Daniel Mercer. The world moved on. But history doesn't disappear. It waits. Years later, during a congressional inquiry into financial oversight reforms, a question surfaced. Not about a collapse, but about a prevention. A classified appendix was requested. Reluctantly released. Heavily redacted. Inside it was a single footnote. One sentence. Stability was preserved due to the discretionary judgment of an internal compliance officer. No name. No explanation. But the architecture was there. Documented. Irrefutable. The system hadn't failed. It had been exposed. And the final truth wasn't that Daniel tried to destroy it. It was that he saved it. At the cost of his career, his credibility, and his silence. Because the truth about systems like these isn't that they're evil. It's that they require someone to disappear when they work. Daniel Mercer didn't become a whistleblower. He became a structural necessity. And somewhere inside Liberty Crest Bank, deep within its compliance framework, the system still exists. Renamed. Refined. Waiting. Because markets will always demand certainty. And certainty will always demand a lie.